Okay guys, so as promised I'm going to do a few revision lessons because I know you've got your exams coming up for accounting, and last night I was emailed, can I do a lesson on control accounts? So I thought I'd do a bit of research, remind myself what control accounts are, and I thought I'd do a lesson on it, so I'm going to go through what they are, and then I'm going to do a little bit of a past paper question at the end. So, control accounts concern your trade creditors and your trade receivables, your debtors and your creditors. People who owe you money, people that you owe money to. So, trade receivables, people who owe us money, also known as debtors. So, it's an asset, trade receivables, because people owe us money. So the brought down must be on the debit. Now, what can increase our trade receivables? Well, we need more people to owe us money. How are we going to make more people owe us money? Well, we're going to have to sell goods to people, so sales. However, this is vital, it can only be sales on credit. Because if it's a sale on cash, no one owes us money. We've sold them goods, they've paid us. The money's already changed hands, there's no asset or liability there. So, what can go against our sales account? What can make us be owed less money? Well, if someone pays us, it's going to decrease the amount owed to us, obviously. So payments received. So, say if we had trade receivables of £5,000, then £2,000 is repaid to us. We're going to have only £3,000 left for trade receivables because less people owe us money. Therefore, our assets decrease. But in that sense, by the trade receivables, our assets also increase because our bank account will increase as long as it's not an overdraft. If it's an overdraft, then the current liabilities will just decrease. It will balance out in the balance sheet. And that's how that works. Okay, another thing that can lower the amount owed to us by trade receivables is discount allowed or received. Well, it's going to be allowed. That is an expense in the income statement. And basically, say if we sold goods, then and we give them a discount, they're obviously going to owe us less because we've said they can pay us less. Very simple, that one. And another one, what goes against sales in the income statement? What's just below the sales revenue bit of the income statement and is taken away? It's returns in, or sales returns, whatever you want to call it. Also, one more thing, contra. So returns in, why does that decrease the amount? Well, we sold goods to someone and we thought they owed us money, but then they returned the goods. So they don't really have to pay, they don't owe us any money anymore because they don't have the goods anymore. And the contra, that's if a supplier is also a customer. So say if we sold goods to someone of £200, a supplier and a customer, the same person, yet we owed them £200 at the same time, so we owe them £200, they owe us £200, we could just offset them against each other and they cancel each other out. Because there's no point in us both paying each other £200 because it's just pointless, it doesn't need to happen. So with the carry downs and brought downs, we should always have the carry down here and then the brought down back again on the debit side because this is an asset account. So where do these values go to in the rest of our T accounts? Well, if we have a look, sales, well, sales is going to go in the sales day book, and returns in are going to cancel out, not cancel out, but count against them sales. They're going to decrease the amount we think we sold. So we'll just draw up a little T account here. This can be our sales account. Now, what side do sales go up on? They go up on the credit. And I'll explain why in a minute, but they go up on the credit because they're an income. So these sales here, they're just going to drop in to here. So we sold goods, so I'll just put sales, but usually it'll be someone's name, maybe, that we sold goods to, and the returns in will cancel out. And we debit that because they decrease our sales. That's that. Okay, so we've sorted out with the sales and the returns in. But what about the payment received and discount allowed? What other T account do they relate to? Well, if we receive payment for someone, well, that must simply just be a cash book item. We receive money, and the cash book account is obviously, it's going to be, well, it can be a debit or a credit, but it goes up on the debit. If we receive money, it goes up on the debit. So a payment received, so payment received, that just drops into here. And then discount allowed, that's going to count against it. Okay, right. Why does sales go up on the credit? Well, I was taught a little trick in my first year, and it's probably the most helpful thing I've ever been taught in accounting. And it's to do with T accounts and why they go up on certain sides. And if you can master this, you can probably master anything in A-level accounting. So this is just a T account. So what goes up on the debit, just in generalized? Well, assets go up on the debit. What also goes up on the debit? Only one more thing, but what else goes up on the debit? It's expenses. So if you had your depreciation account, say we had our depreciation account down here, depreciation, just shorten that. The actual depreciation for the annual will be on this side. So then when it's dropped in to the motor vehicles account, so MV, you'll have the value here of the, so say we had a car, £200. The depreciation there, let's say that's 50. Then we're going to have our carried down of 150, and now it's worth 150 again. Lost myself there completely. So there you go. See, so depreciation and expense therefore counts against assets on its credit. So what goes up on the credit? Well, one thing I mentioned was sales, which is an income. So rent received, stuff like that, will go up on the credit. Another thing, very simple, the opposite of assets, liabilities. And one more thing, what's the other thing in the balance sheet besides assets and liabilities? It's your capital. So the opposite of capital is drawing, so drawings will be on that side, but you can probably gauge that just from the fact that capital is on the credit side. So how do you remember this? Well, I was taught a little acronym, which is you go to A&E if you are ill, IL. I know it sounds cringy and cheesy, but it's really easy. So you go to A&E, assets expenses, if you are IL, ill, and just hopefully you can remember the capital. So that's the basis of T accounts. So I've gone a bit off topic there, but that will really help. So now what I can do is trade creditors. I've done this one already. So this is just, it's a reverse of trade receivables really. Sales on the trade receivables account were on this side, but it's just the opposite. Purchases on this side. We had payments received before, we had payments made, we had discount allowed before, we had returns in before. It's just the complete opposite really. So what can I do? Right, well, I can draw a purchases T account. Now, take into account what I've just said, what is purchased out of them 5 things. It's an expense, it costs us money, it counts against our revenue to give our gross profit. So purchases are going to go up on the credit, oh no, sorry, they're going to go up on the debit. And therefore returns out are going to cancel that out. We've given goods back, we don't owe the money to people anymore. Very simple. Once again, contra, same theory applies. If someone owes us money and we owe money to them, we can cancel that out, we can offset it off. Discount received, we receive the discount, that's an other income. And payments made, that's going to decrease our cash book, but it's also going to decrease our trade creditors. So we have less money in our bank, or we've gone deeper into an overdraft if we're already in overdraft, but we owe less people money, so it'll still cancel each other out in the T account methods. So now on to the actual past paper question. I'm rushing through it a little bit because I think when I upload a video that's shorter it gives it a better definition, so it'll be easier to read for you guys and you won't have to print the questions off. So we have 5 transactions and we have a bond supply account. Well, what you can do is just cross that out. This is just a trade creditors account. Really, it's people who we owe money to. Right, so balance, so that's just your brought down. And as I just showed in the last sheet, brought down for a trade creditor is always on the credit because it's a liability, a trade creditor. It's people we owe money to. So we're going to pull up the 1st of March. I'll just put the 1st. Brought down 4290. Okay, so we purchased some goods on credit, and what's vital to read from that is the word credit. If that said purchase goods and on cash, we wouldn't even be thinking about it. We'd have to completely ignore it. But because it says on credit, we have to take it into account. So that's how much money we owe to bond supply, a supplier, 4290, and we've just purchased some goods. So we're going to increase the amount we owe, and that's going to go into our purchases T account. Because we've increased the amount we've bought, we've also increased the amount we owe to creditors. So that's now going to come 1226, I believe. Yeah. Okay, now returned goods to bond supply. Well, what's a returned good? Well, bond supply is a supplier, so we must have bought goods from them. So we've purchased and then we've returned it to them. So that must be a return out, or a purchase return, however you want to say it. I say return out, return in. So on the 8th, it's going to go against our purchases. Let's say we purchased them goods and we've returned that amount, so we owe less money to them. So that's just going to be returns out 164. Now check paid. So now that we know it's a check, we know we've paid it on credit. We haven't paid in cash, and we've received a discount. That bit's crucial. Well, we've received a discount. That must be a discount received. It's in the wording. So on the 15th of March, we've got 2 transactions for this. Not only did we make a payment, so that's going to be bank, it's going to decrease the bank. Not only did we make a payment, we also received a discount. So discount, sorry for abbreviating it, just so I can fit it in. So we made a payment of 2820, but we also received a discount before making that payment of 148. So both of them are going to count against the amount we owe. We've paid an amount, so it decreases the amount we owe, but also they've given us a discount, so they said you owe us less money than you initially thought. Okay, now this one's important. Julie's bank returned check unpaid, 2820. Right, well what's that going to do? Well, we thought we'd paid back 2820, but we found out we haven't, because we can't give them the money. We obviously don't have the money. So we're going to have to add back on that amount that we owed. We still owed at 2820. So it's sort of like correcting an error in a way. You've just cancelled it out. But if we cancel out the bank, we also need to cancel out the discount received. Maybe they only offered us that discount because we were paying within a month or so. And now that's been set back, we can't pay anymore, so we're going to lose the discount. So now, once again, we're going to have to cancel it out. We're no longer receiving the discount. because we're not paying. 148. So, what do you know about a trade creditor account? Well, if the brought down's on this side, the carried down is going to have to be on this side. I think it's 31 days in March, and the carry down is 5352. Therefore, both equal 8484. And then, because trade creditors is a liability, the brought down for the next financial period is going to be on our credit. And that is control accounts, I guess. Just make sure you know this. This is the most important thing I was ever taught, I think. It's so crucial to know that. And yeah, any questions, please email me. I've not got any topics lined up yet for a revision lesson, so please email me if you've got any ideas. I could do bank reconciliation, anything really. I've been thinking about doing T accounts because that underpins every single accounting transaction there ever will be, and I think that's really important. So thanks for watching, and I'll see you guys later.